U.S. stock bubble alert, Buffett Indicator. Hits 216%. Buy the dipper bail? Picture this. The U.S. stock market is now worth more than 2 times the entire American economy. That's not hype. That's Warren Buffett's favorite crash predictor, flashing blood red at 216% right now. Late November 2025. Higher than before 2008. Higher than the dot-com peak. So the big question, is this the biggest bubble of our lifetime? Or the greatest buying opportunity before the next leg up? Stick with me for the next 8 minutes. I'm breaking down the hard data, showing you exactly what happened the last times we saw these levels, and giving you 3 bulletproof hedges you can set up before the weekend. First, the 2 metrics that have called almost every major crash since 1929. Number 1, the Buffett Indicator, total market cap divided by GDP, just hit 216%. That's 76% above its long-term trend. Number 2, Robert Shiller's CAPE ratio, the inflation-adjusted price to earnings over the last 10 years, is sitting at 38.94, about to cross 39. For context, it was 32 in 1929, 44 at the 2000 peak, and only 27 before the 2008 drop. These 2 signals together have been right 7 out of the last 8 recessions. Not perfect, but scary accurate. Let me take you back. 1929, Cape 32. Great Depression, stocks down 89%. 2000, Cape 44, dot-com bust. NASDAQ down 78% in 2 years. 2008, Buffett Indicator crossed 200%. Global financial crisis, S&P down 57%. Every single time valuations got this detached, the party ended badly. And right now, the top 10 stocks, your Apples, Nvidias, Microsofts, make up 36% of the entire S&P 500. That's the most concentrated the market has ever been. One sneeze from big tech and the whole index catches pneumonia. So are we doomed? Not necessarily. Bubbles can stay irrational longer than you can stay solvent, but they never end well when the music stops. Here are the 3 hedges I'm personally using right now. No fluff, no paid promotions. Hedge number 1, gold. Gold is already up 55% year to date, from $2,624 in January to over $4,147 an ounce this week. It's the classic crisis asset. I'm keeping 8 to 10% of my portfolio in physical gold or the GLD ETF. Simple, liquid, and it explodes when paper assets crack. Hedge number 2, Treasuries and quality bonds. The 10-year yield is still around 4%, and the yield curve is uninverted. History says when the curve flips back, bonds rally hard. I'm putting 20 to 25% into a ladder of TLT or individual treasuries. If the Fed does the 3 cuts they're signaling for 2026, bond prices jump 10 to 15% easy. Hedge number 3, global diversification. The U.S. is 60% of the world index, but trading at twice the valuation of Europe or emerging markets. I'm rotating 15 to 20% into VXUS, the international ETF, with extra weight on India, 6.8% GDP growth, and Mexico, now America's #1 trade partner. Cheaper valuations, faster growth, and you're not all in on one overvalued market. Real talk, I'm not selling everything. I still own the Magnificent 7, but I'm hedged, I'm sleeping at night, and I'm ready for either outcome. Quick question for you. On a scale of 1 to 10, how scared are you of a 2026 correction right now? Drop your number in the comments. 1 is buying everything. 10 is hiding under the bed. I'm personally sitting at a 6. Let's see where the FinOrbit community stands. Bottom line, 216% valuations are a 5-alarm fire, but fire sales can also create millionaires. Protect yourself first, then decide how aggressive you want to be. If this video helped even one of you avoid a 30% drawdown, my job is done. Hit that like button if you're hedging with me, subscribe, and turn on the bell so you never miss the next warning, and I'll see you in the next one. Stay sharp, stay diversified, and I'll catch you on the next orbit. Kunal out.